In order to buy put options inside of Interactive Brokers, you need to have three things. Number one, you need to have a stock where you think the price is going to go down. Buying put options is a way you make money when the price declines in this direction. When you see a chart like this, like Meta's over here on the right side, that is not the type of chart you want to go ahead and buy puts on. You want to do this when the stock price is about to drop or is in the middle of dropping. That's when you make the most money. You'd be much better served looking at something like Costco, where the price over here is about to drop down lower. And as the stock price begins to drop, you begin to make more money if you're buying puts. Now that you know what the chart's supposed to look like when you're doing this, you want to look at the options chain, look at the expiration date. That's thing number two. Very, very important. When you're looking at a 0-day expiration like currently shown, the bid-ask spread is going to be very, very small, and there's going to be almost this lottery mentality. If you decide to buy one of these contracts, you're basically flushing your money down the drain. You need a big-time movement for this to actually come to fruition, make profitable for you, because time decay is working so quickly on a same-day expiration. I personally like to go at least a week or two out. If I was looking at this potential trade setup right here for Costco, I would be going out to the 14th at least. It also happens to be the third trading day here in the month, which is also a big day for options expiration and increased volatility, which is a good thing. And what we want to do here, after you have the expiration date locked up, you want to go to door number three, which is understanding the strike price, which makes a huge difference in what you're going to pay and potentially what your profit's going to look like as well. So checking out the strike prices, as you're looking through this, the further below the current stock price is 529 and change, okay? The further down you go, the more unlikely it is for you to be profitable. And because it's more unlikely in these areas to be profitable, you're going to pay less for those contracts. If you want to go above the current stock price, it's a more likely chance for you to be profitable, and you're going to pay more in the bid-ask spread. I like to look at these kind of bid-ask spread around the current stock price when I'm buying puts myself, and look at the ones with the highest amount of open interest, this little column right here. If you don't have to toggle that on, you can just insert a column, and you can add this in here through these kind of areas right here. So we want to look at open interest. For example, we're looking at the 525 strike price, and this bid-ask spread is currently 3.85 and 405. We're going to fill it somewhere in the middle, hopefully. To do this and actually execute this trade, we go in and we click this button right here. Price is moving up a little bit. We just hit the 530 mark. We're still going to go with this 525 strike. Click that blue button for buy. If it pops up here and is showing the sell, just click it over there and click the buy button. You're good to go. Quantity of one, limit order, market order, stop maybe, trail, snap market, whatever you want to do here. It's up to you. We've talked about these in other videos on the channel. Check them out if you have the time to do so. You can check out the video right there for all the different order types, Interactive Brokers. Let's keep it at a limit order so we can actually choose our price we're going to pay. And we want to go in there and just click the midpoint. We want to always make sure we're getting the mid here if we're doing the limit order. Day is good. And we're going to open up this advanced tab and do two things in here. Critical steps. One, we want to attach a stop loss and a profit taker. Well, in this case, let's just do a stop loss so that we protect our downside. So that we put up this 395 in capital, so 395 bucks. And what we don't want to do is have this kind of go to shit and just evaporate entirely. We want to say, let's protect half of it in this case. So we want to go here, and our stop's going to be half of 385 is the midpoint. Now it keeps dropping down there. So what we want to do here is go ahead and down. We're going to just go down, make it nice and easy. Let's say it's 4. We're going to go down to $2. So we're okay with losing potentially half of our investment here in this trade. We think we have a good idea of the market going in the right direction. We're going to go ahead and lose potentially 2 or half of our position, $2 times 100, so 200 bucks. And then we go in and we click margin performance, and we want to have our performance profile clicked on. Right here, we would see that our profit probability is 25%, so not great. Our max return there, 52K. If the stock goes to 0, that's our max profit. Max loss, again, 396. We have that stop loss in play as well, so it'll be 200 bucks, not 396. We're going to protect against some of our downside risk, which is always good for proper risk management when you're trading. And then you have the Greeks down here. If the price goes down by 30% in 2 weeks, you're making bank. 20% a little bit less, 10% a little bit less. Current price, you'd be losing a little bit if you just stay where it's at for the 2 weeks right there. If the stock price moved quickly in the opposite direction, went up, you're losing big time cash, losing all your kind of capital until it hits that stop loss point again, which is at that $2 mark, so 200 bucks down the tooth versus the 396 shown right here. That's why we put a stop loss on, is to manage risk in our trades. We always want to limit our risk to about 1 to 5% of our capital when we're trading. That's good trade management. It keeps you in the game longer, and the longer you can survive, the longer you're going to thrive over time. So we're going to do this, and we're going to make sure that we're going down in our account value. That's showing the Canadian conversion for myself trading here in Canada. It'll show US dollars if you're just trading with US funds in your account, and your account post trade is going to be less than current because you are buying a put option and you're paying that money out of your account to the seller. Transmit that baby. We're going to override and transmit. What's it saying? Stop order. That's fine. Yeah, we want that. Transmit. So we've got our buy order in for the actual contract. We've got our sell stop attached to it down here, the stop loss right there. Once this limit order is hit, it's going to go, it's going to execute. If we wanted to, we could change this limit order here. We could edit it to a market order and get it filled right away. It's going to update. We could do that to get it in the hopper right away. Let's do that. Click it.
Order filled.
Order filled. Here we go. As Interactive Brokers likes to say, it's in our portfolio now, and we'll scroll down to it here. We've got a Costco put right there, 525 underlying, down $10. That's kind of the slippage between the bid-ask spread and some kind of just price movement. And then we have our average price, the last, and our delta, and our time until expiration. It happens 14 days. So we're live there, and our stop loss is still attached to that. You can see it down here. It is in there. It is in the hopper. It's not going to go anywhere until it actually is hit, or we cancel out this trade and hopefully do it in a profitable manner. So that is how you buy put options here at Interactive Brokers. The quick and easy things, the three things to think about again are finding a stock that's going down in value, finding the right expiration date, and finding the right strike price. Three critical elements for good trading practices when you're buying put options. If you got some value here today, please subscribe to the channel, like the video, and I will catch you on the next one. We're talking more about options in general, how they work, how to trade them, and my day-to-day strategy. You can check it out right here in this next video.